Good afternoon, everyone, and thanks for joining us for today's webinar. My name is Chelsea Amin, and I'm a director on the National Accounts team at Baron Capital. I'm joined by Chairman, CEO, and Portfolio Manager Ron Baron, as well as Portfolio Managers Michael Baron and Neal Rosenberg. In terms of the agenda, we thought we'd begin with some opening comments from Ron, followed by overviews of the Growth Fund and Wealthbuilder Fund. Ron, let's kick it off with you. 2022 was clearly a volatile year for a variety of reasons: inflation, higher interest rates, lingering pandemic concerns, the list goes on. But on the bright side, Baron Capital continues to grow and invest in our business. Let's have you start with a brief firm update and then any opening comments that may be interesting for our listeners.
Thanks, Chelsea. Hi, everyone. I thought I would talk briefly about our firm and then about our outlook. And so about the firm, I started my career in 1970. We opened Baron Capital in 1982. We had 3 employees then, Susan Robbins, Linda Martinson, and myself. We're all still here, and we've grown from 3 people then to 191 people as of today. In fact, I was just walking down on the floor below, and the risk management committee was meeting, and there are either 9 or 10 people there. And one of them, Fulbright scholar, really interesting, nice people. So I was very impressed, and we continue to grow. Last year at this time, we had 167 people. Last year at this time, we had 2 floors. We now have 3 floors. We're about to open the 3rd floor in probably about another month. I think that one of the things most interesting about our business, it's a family business. The most interesting thing I think is that we have never, in the history of our firm, had a layoff, not one. And so one of the reasons we're so attractive and we're able to attract such great employees is that they know that we're investing in them. Just like we invest in the executives who run businesses in which we invest on behalf of ourselves and our clients. So we invest in them. And that means that people can work here and they can have assurance that they can buy a house and get a mortgage and take vacations and plan for retirement and plan for their children's life events. They can do that, all these things. And we've been doing this for 41 years. This is our 41st year. And not once have we ever had a layoff. And so all you read about is salary cuts from staff and reductions, and we don't do that. So we get great people, and we are investing in our business so that we can provide great service to our clients. And I think we have. And the great performance is that our funds, 98.6% and 98.7%, have beaten the market since their inceptions. 98, and then 96 or 97% are in the top 20% of mutual funds, and 3 of our mutual funds are either in the top 1% or are the #1 funds in their categories since inception. So our performance has been very good, and I think it's because of the process we have about having this long-term perspective about everything we do, about investing in our business, about investing in people, and about investing in companies on behalf of our clients, that companies we think are run by great people, competitively advantaged, have very strong growth prospects. That's our firm update. We're continuing to grow, and everyone else is, who knows. Number 2 is about the outlook. And so I see that you watch television every day, and it's scary. Everyone has a negative outlook. They think that the economy is going to be bad, and we think we're going to have a recession, and they think that the war in Ukraine is going to last forever. You can make up anything you want, and everyone has the same negative outlook. We have the same outlook, and always have, about our country and about our business and about the people who work here. We're optimistic, always optimistic. Have this long-term perspective. What's really interesting to me is that I was giving a speech. This is our 40th. Last year was our 40th anniversary. This is our 41st year. And what was really interesting to me is that I look and I see that in my whole career, there's been the career since 1970. So it's 52 years now, 53 years. And this entire period of time, there's only been 1 year where the news was good consistently for the whole year. That was in 1989 when the wall separating Berlin came down. So there's been walls all over the place for a long time, but the wall in Berlin came down. And everyone talked about a peace dividend. We're not going to have to spend all that money in defense. We're now going to have that money we can spend in making everyone's lives on the planet better. 1 year. So other than that, there's been wars, and there's been pandemics, and there's been inflation, and market crashes and financial panics, and everything you can think of, events, 9/11. So everything you can think of that you can think of something negative, and it's happened in my life, everything. And at the same time, when we started Baron Capital in 1982, in March of 1982, the Dow Jones was 820, I think, 820, and it's now 33,000. So it's up 41 times. So all the bad news, the market's up 41 times. And the reason for that is that the economy, our economy, has been consistent every time you have recessions, but the economy grows 7% a year, 4 or 5% inflation, 2% real, every year for my whole life. And for a whole year, my whole career, every year, 7%. The stock market grows 10% on average, 9 or 10%, and we grow on average low to mid-teens. And that record makes us one of the most successful money managers, and of the $39 billion that we manage now, and we started off with 10 million. So with the money that we manage now, the 39 billion, 37 billion are profits that we made for our clients and ourselves. 37 billion out of the 39 billion. So it's not like we made a good return with a small amount of money. We made all the profits, all the money we manage is from profits that we made for our clients and ourselves. So we have a stickier business than others, and our business over the long term has taken in money. We're now being more aggressive in raising money. But again, our business is about making money for our clients. We're not a business driven about trying to make the most profits for ourselves. So we do fine. We invest the way our clients do, and we're the biggest investors in our businesses. Somewhere around something over 6% of the assets we manage are our own. It runs anywhere between 6 and 7%, depending on the volatility of the stocks that we own. But we're very optimistic about our client assets, and optimistic about the returns we're able to earn. We think we'll be able to continue to outpace inflation. So therefore, if everything doubles in price every 14 or 15 years, 4 or 5% a year inflation, which is what's the long-term average, we think we will do better than that and better than the stock market because we invest in companies that are faster growing. So with that, I'll turn it over to two of our exceptional managers, Michael Baron and Neal Rosenberg, who joined me as partners in 2 funds that they are co-managers of. So it's not just me that's managing money. We have a lot of young people here, and at least young to me is in their 40s. So with a lot of experience, and 20 years lifetime experience in investing. And so I'm really pleased at how they're developing, and you should be assured that we have 43 other people who are working here and growing 2 or 3 or 4 people a year on average that are learning and working together with us for a long period of time and becoming better and better managers. So with that, I'm going to leave you with the 2 of them, and thank you very much for investing with us.
Perfect. Thanks, Ron. Really appreciate it. Neal, with that great intro from Ron, maybe you could start with some comments on the growth fund in the fourth quarter.
Sure, absolutely. Thanks, Chelsea. So we had a very strong fourth quarter. The fund gained around 12%, which exceeded our benchmark, the Russell 2000 growth, by 780 basis points. It also exceeded the S&P by about 440 basis points. Our performance in the quarter included almost 1,000 basis points of favorable stock selection. That really shows that our results came from owning stocks that performed better than the index, and not just from having picked sectors that were temporarily in favor.
Wow, 1,000 basis points. That's terrific. Congrats, Neal and Ron. And it's great to hear that performance was driven by stock selection. And I know, in the past, we've talked a lot about our process and the fundamental analysis really enabling us to generate that favorable stock selection across multiple cycles. So to put some numbers behind it, can you talk a little bit about the fund's longer term performance?
Yeah, sure. So we're really pleased with the performance over the past 5 years. And of course, as Ron alluded to, and longer periods, including since inception. So as I mentioned, for the full year 2022, the fund outperformed by about 400 basis points. This followed an excellent 2021, where the fund gained over 20%, which is around 17 percentage points ahead of the benchmark. Over the past 5 years, the fund has compounded at 11.2%, That's 760 basis points ahead of the Russell 2000 growth and about 170 basis points ahead of the S&P annually. Most important is how we've generated those results. Looking at the past 5 years, we've had a minimum of 470 basis points of favorable stock selection annually and an average of around 870 basis points. The past 5 years has included both rising and falling interest rates, expanding and contracting GDP, tight and loose labor markets. And as I'm sure nobody has forgotten, and as Ron alluded to, it's also included a pandemic, the largest European land war since World War II, the first new sovereign in the UK in almost 4 generations, and 3 US election cycles, amongst other headlines. We never tried to reposition the portfolio to anticipate or to react to any of those events. Instead, our performance has come only from favorable stock selection. That track record really gives us confidence that our process is repeatable and scalable and is well positioned to deliver superior returns over time across all market cycles.
Great, thanks, Neal. Maybe with that, we'll take a step back. I know the last time we hosted a webinar was in July, so clearly a lot has changed since then. But at that time, you were highlighting that businesses were continuing to report solid financial results despite their attention being on slowdown risk and the strengthening dollar. As you look across the portfolio today, have trends generally continued to be resilient?
Yeah, absolutely. Despite a lot of growing warnings of a recession, the businesses that we've invested in really have continued to report really good financial results. Let me give you a couple of examples, most specifically from December and early January, which are effectively real-time data. So market data vendor FactSet generated earnings growth of 23% in its most recent quarter. That was a pretty meaningful acceleration from 9% in the prior quarter and around 20% during the prior year. FactSet's really reaping the benefits of a multi-year investment cycle to bring new products to market, to consolidate spending from competitors, and to realize price increases. FactSet's new CFO has also imbued the company with vigorous expense discipline, which is really helping margins. Separately, Vail Resorts, the premier ski resort network in North America, reported continued strong conversion to ski passes, which grew around 6% versus the prior year through early December. Amazingly enough, Vail's total passes have almost doubled in volume since December 2019, while revenue from passes has grown almost 53%. Finally, Guidewire Software, which is the leader in P&C core insurance systems, reported excellent financial results that included 40% constant currency growth in subscription revenue and better than expected net new bookings. Guidewire's invested heavily over the past 4 or 5 years to transition its software to be delivered in the cloud, and it's now benefiting from ramping customer adoption. So we're encouraged with the trend so far. We're right on the cusp of another reporting season, so we'll continue to get lots of new insights over the next few weeks that we'll look forward to sharing with all of our investors.
Great. Well, I mean, those data points certainly seem encouraging, so hopefully those trends continue to be strong. And I know you're aware of investor concerns around the cost pressures from inflation and the persistent supply chain issues, et cetera. And I know you talk about you take a long-term view and you really stay focused on finding businesses that can generate that attractive growth rate across cycles. And it seems that a lot of those businesses have recurring or at least highly visible revenue models. Can you maybe talk about why this is so important and provide some examples?
Sure. So that's a great observation. Definitely, most of the businesses that we've invested in sell their products on a subscription basis, and that gives them high levels of recurring revenue. These subscriptions usually have annual or multi-year terms and can therefore only be canceled at a finite number of predetermined time periods. As a result, these subscriptions help dampen the volatility of a company's revenue to short-term fluctuations. In addition, these businesses tend to generate outstanding retention rates, which mean that very few customers ever even choose to cancel their contracts. These high retention rates come when companies sell highly differentiated products, when they deliver significant value relative to their cost, and when they become deeply embedded in their customer workflows. Let me give you one example, which is MSCI, the largest position in Baron Growth Fund. We estimate that around 97% of MSCI's revenue comes from recurring sources. This includes 75% of revenue from subscription contracts, which carry an average length of over 1 year. It also includes revenue from asset-based fees. These fees generate recurring revenue and are governed by multi-year contracts with a sponsor, but they can be impacted by fund flows and by fluctuations in asset prices over the short term. Conversely, just 3% of MSCI's revenue is non-recurring and therefore would need to be resold in a future period. On the retention rate side, MSCI's aggregate retention rate is around 96% on a year-to-date basis. Since the company's been public since 2007, we really can look at retention rates over past macro cycles. In MSCI's flagship index business, retention rate has ranged from a trough of 92% during the financial crisis to a peak of 96% last year and in 2022. These are really remarkable retention rates that demonstrate the criticality of MSCI solutions and the value prop that they generate relative to their cost. We see similar long-term evidence of durable recurring revenue with high retention rates throughout Baron Growth Fund. That really gives us a lot of confidence in our investment's ability to generate attractive financial results across cycles.
That's great. Thanks a lot, Neal. Appreciate all those comments and certainly the examples. Before we transition to Wealthbuilder, maybe we could close with your outlook and something that's always top of mind. Why is now a great time to be investing in small cap?
Sure. So clearly there's a lot of focus on the threat of a recession this year. We don't have a discrete macro forecast, but as I pointed out, when we speak to our businesses, we really find that conditions have remained relatively stable so far. Most importantly, we think our businesses are well positioned to drive growth and to really thrive in all macro environments. Like MSCI, all of them have positive secular trends, high barriers to entry, recurring revenue, and pricing power. Most will generate attractive revenue growth and even better free cash flow growth, regardless of whether GDP growth is positive 3%, negative 3%, or somewhere in between. And when growth is harder to come by, these investments are likely to become more highly valued by the market. We've also found that recessions create opportunities for the best-in-class businesses that we invest in. These businesses tend to take market share during recessions. That's because they continue to invest during downturns. They take good care of their customers, and they can finance their businesses. Conversely, their weaker competitors tend to cut costs, reduce staffing, and they don't invest for the future. As a result, our businesses tend to grow faster coming out of recessions. That puts upward pressure on earnings estimates and is always good for stocks. Our businesses are also poised to improve their growth through accretive M&A. Most of our investments could be acquirers, but some could be targets as well. With respect to why small caps, we think it's a really opportune time to be focused on small cap growth stocks. In 2022, small cap growth stocks underperformed large caps by about 740 basis points. That's pretty typical leading into a recession. Investors tend to rotate towards larger, more stable, and probably less risky stocks. But as the macro cycle improves and sentiment ultimately improves, small cap stocks tend to outperform. We expect to see the same story play out here. So we think small cap growth investing is particularly timely. And within the small cap space, we find there are really few better funds over the short, intermediate, and long terms than Baron Growth Fund.
That's certainly great to hear, Neal, and I think a perfect transition to Wealthbuilder. As a reminder for everyone on today's webinar, Wealthbuilder is an equity allocation strategy that invests exclusively in other Baron funds. The fund really enables investors to obtain growth equity exposures across market caps, geographies, and sectors. So I'd like to start by saying congratulations, as the fund celebrated its 5-year anniversary in December. Congratulations. And maybe with that, we can start with a quick performance update and key drivers, which I imagine, as we've gotten a lot of questions on, will cover a large holding that is top of mind for many of our investors, Tesla. Michael?
Great, thank you, Chelsea. And tough to follow Neal after that go through with their performance over in Baron Growth Fund. So good work over there, Neal. It's been tough, to be very frank, for Baron Wealthbuilder Fund. This past quarter, the fund was up 1.14%, lagging its index, the S&P 500, which was up 7.5%. And for the year, the fund declined 32.59% compared to the S&P of 18.11, a decline of 18.11 for the S&P. Over the long term, we are doing better. Over the past 3 years, we've surpassed the index 8.6% compared to the S&P of 7.6. And for the 5 years and since inception, same time period, the fund is up 10.36% compared to the S&P, which is up 9.42%. It's in the top 2 percentile of its category. And I'll get into a little bit more about what's going on over the long term and how we've been able to achieve that in a bit. But as Chelsea alluded to, we face some headwinds in this current period, and that mainly stems from Tesla. This is a highly diversified fund. It's an investment equity allocation fund, investing in other Baron funds. It gives broad equity growth exposure across market caps, across geographies, across sectors. But we're not, very, very small positions. We do take, sizable stakes, and our top 10 positions account for around 30.5% of the overall portfolio. Tesla being the largest stake, it had an average weight in the quarter of 7.12%. Its decline of 53% over the quarter detracted 5.25% from overall performance. It's really only held in two funds, in size in two funds. It has maybe a small holding in a few others, but in size it's held in Baron Partners Fund and Baron Focused Growth Fund, two of our concentrated strategies. And I think it's helpful to look back at the history of those two funds in terms of how big those positions got and why. We started making an investment in Tesla back in February of 2014. Our initial purchase for Baron Partners Fund was $11.91. Over the next 2 years, those two funds accumulated 18 million shares at an average price of $14.29. And they grew substantially from there, not because we were buying it all the way up, but we were correct in our analysis. And the stock did extremely well over their next, whatever it was, 6, 7, 8 years. Back in 2014, when we first made the investment, the company was producing 35,000 vehicles. In 2022, the company produced 1.37 million. So 35,000 to 1.37 vehicles, highly diversified its product lineup. It was basically making one vehicle back then, a highly specialized ultra luxury electric vehicle, and now much more mass market with the Model Y and the Model 3, getting to the 1.37. We didn't stay pat over that time. We've been reducing our share count, but it's very hard when the stock is doing extraordinarily well, keep on going up rapidly, to trim fast enough, especially when you continue to believe in the long-term prospects of the business. So over this time period, we sold 5.24 million shares, or basically 29% of our original position, at an average price of $226.18. So remember, we bought these stock for 18 million shares at $14.29, and we sold for an average price of $226.18. So made a handsome profit for our investor and client base. We're often getting the question, why didn't you sell more? We didn't sell more because we still believe in the business. They are still in their infancy in terms of what they're able to do. Like I said, 1.37, 1.4 million vehicles this past year. We put a target that, this isn't going to be 100% of the market, but could be 20% of the market, could be 20 million cars over the long term. Highly diversifying, continue to diversify their product base, more vehicles coming out in the future, more industrial type vehicles and more mass consumer type vehicles. They also can improve their profits. We also see their ability to go into ancillary businesses, such as their battery business, autonomous driving, insurance, robotics. There's a host of things that this company can do, and they're only just starting to scratch the surface. This is a great business for the long term, but when you have such a high growth business, you can face this kind of volatility. People are saying, basically, what happened? Why did this go down so rapidly, so quickly in this period? There are a lot of factors. Mainly, the headlines are Elon Musk, highly visible CEO, founder, CEO, has been in the headlines about his acquisition of Twitter. It seems like anything you do in this world, basically half the country is going to love you and half the country is going to hate you. So there's a perception that there's been brand deterioration as a result of his involvement with Twitter. We'll see how that plays out. There's also been stuff going on in China. China's zero COVID policy and then reopening, outbreaks over there. China's a big market for us. It's been a slowing aspect in our production and purchases over there. Looming recession, people fearing how much it's going to hit affordability and sales in the near term. And also the Inflation Reduction Act has caused a delay of purchases. People waiting for that incentives to kick in. But out of those, 3, 4, 5 points I mentioned, this is all very short-term focus. The company is well positioned to get through this, and we think they will. And this is all going to be distant memory relatively soon. We don't know exactly how soon. We're not predicting that this is going to be a banner year, and we predict or we think there could be continued volatility over the short term. But we still believe in this business, and we think that what it's doing, how it's continue to evolve, we're very optimistic about. We feel that over the next year or two, they should be able to introduce a new vehicle lineup of extraordinarily well-priced vehicles. Right now, I would put them in the category of affordable luxury. How do you get into mass? If you want to sell 20 million vehicles, we really need to be a mass-produced vehicle. They should be able to lower their price point by, call it $10,000, still make a handsome profit there, 10 to 15,000 per vehicle. We don't think competitors can match them today. They're not really making much money selling electric, if they're making anything, let alone they're not be able to match that value proposition as we continue to reduce the entry point for a Tesla vehicle. So we remain extraordinarily optimistic, but over this short time period, it did hurt those funds, and as a result, did bring down our overall performance of Baron Wealthbuilder.
Thanks, Mike. I really do appreciate that candor and certainly the granular detail. Understanding that Tesla has been a headwind for Baron Partners Fund and Baron Focus Growth, maybe we could pivot a bit, and can you talk about how some of the other funds have performed?
Sure. Yes, we're not all one investment, one fund, one underlying investment. Not sure if I mentioned it. We do have 455 total investments within Baron Wealthbuilder. I think it's 14 or 15 different holdings, fund holdings, and like anything, there are some that are doing well and some that are doing not as well. Our funds that are doing well tend to have steadier growth investments. As Neal pointed out, Baron Growth Fund is one of them. Baron Asset Fund is one of them. If you're able to find growth investments with a steadier, more predictable business model, they have done well in this environment. And Baron Growth Fund and Baron Asset Fund are actually our two largest positions in Baron Wealthbuilder, each accounting for around 12 or 13% each. And they both performed very well in the quarter, driven by, I don't need to rehash everything that Neal just said, but driven by companies like Arch Capital, driven by companies like Gardner. These are companies that they've indicated for continued growth. For Arch Capital, the insurance pricing is improving, and their property and casualty insurance has grown, I think, around 26% over the prior quarter. So that's done well. Our areas that have done more poorly are some of our more aggressive growth funds, stuff like Baron Fifth Avenue, Baron Opportunity, Baron Global Advantage. They're finding some of their growth rates slowing. Customers are starting to pull back their spend. Some of their sales cycles have been extended. So that gives you a little bit of flavor.
No, thank you. That's certainly helpful. Another question we've been getting recently is, you kind of touched on how you've been navigating the volatile markets, but specifically if you've made, any key changes to the portfolio or notable allocation changes.
Sure. Nothing notable. We do move the fund on the margin. As we're seeing this environment, we want to be in steadier growth names. We have increased our exposure to those types of funds. Baron Growth Fund and Baron Asset Fund have become, like I said, our two larger funds that we've increased our allocation there. Something that I think is often overlooked is that there is a benefit to having an equity allocation fund, such as Baron Wealthbuilder, that we're able to take these kind of volatile periods and do some tax loss harvesting. Over the year, towards the end of Q3, early Q4, we realized around 27 million of tax loss carryforwards. Remember, this is a fund that's around 426 million at the end of the year. So the 27 million of savings that we still have, around 23 million to go, is a nice asset for our client base.
Perfect, thank you. And then I guess just before we conclude, I know you've covered a lot. And, any final thoughts on the portfolio or even just growth investing more broadly?
Sure. As Neal mentioned, this is a tough time for growth investors, tough time for small and mid-cap growth investors. Look, we look extraordinarily different than our index. The S&P is a large cap, go anywhere or broad market, index. Baron Wealthbuilder is, abiding by the Baron Capital investment, philosophy and process, which is finding, great businesses that can grow much larger over time. Historically, that's been small and mid-cap growth businesses for us. 75% of the fund is invested in small and mid-cap companies, all growth companies. Zero, or I think, I'm sorry, not zero, so around 20% or something is in mid-cap for the S&P. So they're a much larger market cap weighting. We're much smaller. It's been a very tough environment for that kind of investing. It's been tough for growth over the past, call it 2 or 3 years, since the COVID, outbreak. And I think it's always important to look how you've done, not just over any one quarter or any one period or 1 year, but how you do over cycles. And when you look at how we do over a cycle, this is a much more attractive story that we're able to, despite being in essentially, we think which had been the wrong part of the market, we think it's going to be the right part going forward. We've done pretty well for our clients. And if I can just turn the quarterly to get some numbers here. Had you purchased this fund, markets really peaked February 19, 2020, the worst time you can actually buy it. Had you bought it at that time and held it through today, the fund returned 12.5%. The S&P, our index, returned 18.7%. But if you look at what I was talking about, the small cap index and the mid cap index, they've fallen 2.98% since that worst time to buy, February of 2020. The mid cap gained 4.7%. So that 12.5% return is much more attractive compared to what's the crux of this portfolio. Over that 3-year period, from end of 2019 through today, the fund's up 28%. Compared to 24.8% for the index. So we beat the index, even though it was a tough time, and hugely surpassed the Russell 2000 and the Russell Mid Cap, which was up 1.96 and 12% respectively. Same thing is true over the 5-year period. We've surpassed the index, the S&P over that period. But we've greatly surpassed the Russell 2000 and the Russell Mid Cap growth. So the fund has an annualized return rate of 10.36%. Since inception, the Russell, I guess I always have to skip the S&P, but the S&P was 9.42, while the Russell 2000 was only 3.5, and the mid cap growth was 7.6%. We do feel, as Neal mentioned, there is going to be this comeback for small and mid-cap growth investing, and we feel this is going to be a well-positioned fund there. But even in a more challenging environment, we've held in there for our clients. And like I mentioned, we're in the top 2 percentile for its equity allocation category according to Morningstar since its inception.
Perfect. Well, that seems like a great way to end. Always like to close it out on an optimistic note. So with that, if no further questions have come in, we will conclude today's webinar. A recording of the webinar will be available on our website, www.baronfunds.com. Thank you, Ron, Michael, and Neal, and thanks to all of our listeners for taking the time to join us today. As always, our focus remains to serve our investors and be strong stewards of your capital. We appreciate your continued support and trust in Baron. Have a good day.